Hello friends, welcome to Learning with Z. This is the fourth video in the series of financial ratio analysis. The topic is efficiency ratios. Efficiency ratio measures the firm efficiency in utilizing its resources to generate revenue and profits. It means how well a company is able to generate output from its inputs like raw materials, assets, etc. Efficiency ratios are also known as turnover ratios or activity ratios. Let us look at some important efficiency ratios in this video. The first important ratio is inventory turnover ratio. It refers to the efficiency with which inventory is turned into sales. This ratio shows how many times a company's inventory is sold and replaced over a period. It is an indication of how effectively inventory is managed by the company. By formula, inventory turnover ratio is equal to COGS divided by average inventory. COGS is cost of goods sold. Although the higher the better, but if the inventory turnover ratio is too high, it may lead to low inventory levels and sometimes stockouts. But if the inventory turnover ratio is too low, it might lead to excessive inventory levels, which leads to high carrying cost or storage cost and extra cash being stuck into inventory. Average holding period. It refers to the number of days the company is holding its inventory. By formula, average holding period is equal to number of days in a year divided by inventory turnover ratio. This ratio shows how fast a company is converting its inventory into sales. A low holding period is desirable because it avoids extra storage cost and it achieves higher cash ratio for the firm, thereby achieving working capital efficiency. Debtors turnover ratio. It refers to the effectiveness of the firm in giving credit and collecting debts for its credit sales. By formula, debtors turnover ratio is equal to credit sales made by the company divided by average debtors in the year. This ratio is very important because it establishes the relationship between credit sales and debtors, that is, the speed at which debtors are converted into cash by the company. It indicates the quality of debtors the firm has and the credit collection policy it follows. Higher the ratio, the better it is for the firm because it shows the firm is aggressive in collecting money from the debtors and maintaining a healthy working capital balance. A lower ratio means inefficient management of debtors and a liberal collection policy, which might lead to bad debts on the company's balance sheet. Average collection period. It refers to the number of days the firm takes to receive payments for the credit sales it made. By formula, average collection period is equal to days in a year divided by debtors turnover ratio. This ratio signifies the time period a firm takes to collect cash from its debtors. The lower the collection period, the better it is for the firm because the firm doesn't take long in collecting cash for its receivables or credit sales, and thereby achieving working capital efficiency. Creditors turnover ratio. It refers to the rate at which company pays off its suppliers. By formula, creditors turnover ratio is equal to credit purchases made by the firm divided by average creditors in a year. This ratio signifies company's ability to get short-term trade credit. If a company is good with timely payments of credit, it establishes a good reputation with the creditors, and they have easy access to credit all the time. A higher ratio is preferred because a firm pays its bills frequently and shows a healthy cash flow position. Lower ratio indicates more credit on the balance sheet of the firm, and it shows a delayed payment strategy. This indicates cash flow problems and working capital inefficiency. Average payment period. It refers to the number of days a company takes to make payment to its suppliers. Average payment period is equal to days in a year divided by creditors turnover ratio. This ratio signifies how long it takes for the company to pay its creditors. For creditors' point of view, this period should be as low as possible because every creditor is interested in getting back its loan. And from the company's point of view, the company should have a timely and frequently paying strategy to build a good reputation with the creditors and to manage its working capital in a better way. Asset turnover ratio. It refers to the company's ability to utilize its assets efficiently to generate revenue. By formula, asset turnover ratio is equal to sales divided by total assets of the company. This ratio is very important because it signifies the relationship between sales and total asset utilization. Higher ratio indicates efficient management and utilization of assets, both fixed and current. Higher revenue being generated on assets reflects good position for the company as compared to other firms, thereby reflecting good growth potential for the firm. The last important ratio is cash conversion cycle. It refers to the number of days the company takes to convert its resources into cash flows. By formula, cash conversion cycle is equal to average holding period plus average collection period minus average payment period. This ratio is very important as it signifies the amount of time each component of working capital is tied up in the production and sale process before it gets converted into actual cash. The lower the cash conversion cycle is, the faster the company is in generating cash from its inputs. This also reflects good management and good future prospects for the growth of the company. So friends, I hope you have found the explanation on efficiency ratios useful. If you like my explanations, please subscribe to my channel. Thanks for watching.